But I think this band or the narrowing of the band would effectively mean slightly more orderly movement, especially at the short end of the yield curve. The markets obviously were expecting a status quo, so the impact was fairly muted as far as the short end of the yield curve goes. We saw an yields increase marginally in the band of about 5 to 10 basis points. The government securities market, or the GSECs as we call it, had the biggest impact in terms of quantum of price fall or the yield rise. Now, this was largely given the outlook table to us by the Monetary Policy Committee, which basically sees some upside risk to inflation. Of course, the FY17 or the March 2017 target for inflation has largely been met, but the FY17-18 inflation target has been broken into two halves. First half at about 4.5%, second half at about 5%. This effectively means that the RBI sees some upside risk to the inflation projections of being able to achieve the 4% mark. Now, that obviously has not been good news for the markets, and even more important is, given the uncertainty on the global economic variables, as also coupled with the monsoon effects, the inflation impact and the transient liquidity, the RBI believes that the rates will remain in neutral mode for some time now. We therefore believe that incremental rate cuts in the near to medium term could not be something which could be conceivable. What should therefore markets look forward to going forward? Expect the markets to remain range bound, in line probably in the band of about 5 to 10 basis points, given the kind of sell-off that we have already seen right now. The 10-year government security benchmark is almost at 6.8%. The good news here is that foreign institutional investors have been continuous buyers, not only in the equity markets but also in the bond markets. January year to date 2017, we have seen almost 1 lakh crores of inflows by FIIs both in the equity and the fixed income markets. In fact, in the first 2 working days of April alone, we've seen approximately 10,000 crores of FII flows into the bond markets. This, we believe, will keep the yield rise under check, with incremental buying coming in from foreign investors as also some investors in the domestic segment. What should be the outlook going forward and the strategies that investors should focus on? In this kind of a scenario, we have been quoting for quite some time that short-term or credit accrual-based strategies seem to be the best fit for an investor seeking exposure into fixed income. Ultra short-term kind of strategies also would probably be a better suited investment avenue over liquid funds, where the yields are at abysmally low levels and we believe will continue to remain going forward. Should one look at duration funds like gilt and bond even right now? Well, we believe that these funds come in with inherent increased volatility given the longer nature of the duration that they have, and therefore a buy on dips could be a potent strategy, probably as a tail end allocation to your fixed income portfolio. To conclude, we believe that the domestic variables are broadly under control with no imminent negatives in the offing. Crude has been under control. Inflation has been fairly orderly. It remains to be seen how the global factors pan out, which will obviously shape the future course of the monetary policy in India. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
What is a mutual fund and what are the benefits of investing in a mutual fund? Your financial requirements are likely to grow over time, and even though your income may grow at a steady pace, inflation will take its toll. Traditional forms of investments such as simple bank fixed deposits or investments in gold may not help you realize your dreams and goals. How do you derive the maximum benefit from surplus funds? How will your dream of buying a car, going on a holiday, or buying a house be realized? Mutual funds might be the answer. What is a mutual fund? A mutual fund is a collective investment tool that pools together money from many investors. These funds are then invested by a professional manager in various companies after carrying out considerable research. Mutual funds allow an individual to take part in the stock market without having to monitor its movements on a regular basis. The fund manager takes your money and invests in a wide range of stocks and fixed income investments or debt. With the technique of diversification, it is possible to counter market fluctuations and minimize risk. So, if a particular group of stocks in a portfolio does not do too well at a given time, there is a possibility that the loss is balanced or minimized by better performing stocks in that portfolio. Once invested, you are given units in the fund based on the amount you have invested. These units are easily redeemable, which means that you can liquidate these units simply and quickly. Net asset value, or NAV, represents the value of one unit of your investment after all fund management fees are paid. NAV multiplied by the number of units gives you the value of your investment. You can invest a lump sum or through a systematic investment plan. In summary, the benefits of investing in a mutual fund are professional investment management, increased diversification, liquidity, ability to participate in investments that may be available only to larger or institutional investors. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello friends, as part of our continuous endeavor to be closer to our investors in order to share our market views on a real-time basis, we have started with a series of interactions that we will have with you on a monthly basis. As part of the first series, I'll be sharing the debt views, broadly the views that we have for the financial year FY16. We have seen a meaningful reduction in rates across various tenors of around 100 to 125 basis points in the last 1 year. The fall in rates that we have seen in the last 1 year was obviously aided by a lowering of inflation and inflationary expectations, a lowering of the current account deficit numbers, sharp disinflationary forces that we saw in terms of commodity prices, as well as the fact that government's adherence to fiscal discipline has driven a lot of comfort in this system, both from an inflationary expectation perspective as well as from a RBI monetary management perspective. As a result, we have seen the Reserve Bank of India already having cut rates twice over since January of this calendar year. We do expect the Reserve Bank of India to cut rates by an additional 50 basis points in the next 6 to 9 months. This will be broadly aided by two primary reasons. One, we will continue to see these disinflationary pressures continue. As the government pursues on its path of fiscal consolidation, a lot of expenditure, 18 months, liquidity conditions in the system have improved significantly because of continued healthy FX flows, because of reducing pressures from currency in circulation, and also because we are seeing an improvement in financial savings. As we go along, we will continue to see a robust FX inflow environment, and also the fact that the government on its path of fiscal consolidation will also ensure that there is an impetus, or there is a support provided to financial savings. Now, that is the reason why we will see liquidity conditions improving. So better liquidity conditions along with a rate cut environment will essentially not only mean that yields come down, but also that the curve starts to bull steepen. And a bullish steepening of the yield curve has ramifications for products across the yield curve. From a Reliance Mutual Fund perspective, we believe that this is going to help in terms of performance of not only long duration products like the Dynamic Bond Fund and the Income Fund, but we also think that it may help in terms of performance of intermediate duration products much more. For example, products like the short-term bond fund, the ultra short-term funds, as well as the corporate bond fund, vis-a-vis what we have seen in the last 12 to 24 months. Hence, we think that investors who are looking at various options of investments into debt products, depending on their risk return profile and depending on their investment tenors, can decide between these intermediate duration products as well as long duration products like the Dynamic Bond Fund for investments that will most likely deliver good returns over the next 12 to 24 months. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello friends, the financial year 2015 has been a great year for equity investors. As the country heralds into a new dawn under the new leadership of Prime Minister Modi, and as the macroeconomic factors turn positive, we have also seen decent returns being made by equity investors in Indian equity markets. As we move forward to the new financial year, we move ahead with a lot of optimism as far as the economy as well as the equity markets are concerned. Our three pillars of optimism continue to be very, very dynamic and very vibrant. The first one is the macroeconomic factors turning positive. The second is the non-linear events, which is a fall in the crude prices, as well as a very robust governance, as well as focus on growth led by infrastructure, railways, defense, and so on and so forth. The third pillar is the earnings growth, and though the March quarter earnings are expected to be tepid, we expect in the next 3-4 years earnings to be quite robust. As we move forward, in the near term also, our view is that the markets might continue to show strength. The triggers for the near term obviously are passing of a few important bills which are likely in this month in the session of the parliament. We also expect the earnings upgrade as far as the country is concerned, and we believe that it's a matter of time before India's ratings are improved. And the most important thing, as we mentioned earlier, is the earnings growth. We also believe that the government spending, which was rather in the last financial year, should pick up pace as we enter the new financial year. With the fall in the crude prices, as also expectation of a slightly more robust taxation collection, we expect government spending led by infrastructure, railways, roads, defense to pick up meaningfully. This, along with a falling interest rate environment, should ensure that earnings growth trajectory comes back on track. We believe that that would be the biggest trigger as far as the equity markets are concerned. Thus, in short, from an Indian perspective, things look to be quite positive. From a global perspective, things have been a little volatile, especially earlier it was the Russian economy, and there was a wide swing in currencies with euro and British pound depreciating quite sharply. There were also concerns about stray countries here and there, including Greece. However, as we speak, things are starting to stabilize, and our view is that with a very easy liquidity scenario almost in all parts of the world, including Japan, China, Europe, and US, money flow into Indian markets, both equity and debt, should continue to be robust. So even from a global perspective, things are looking quite good. In short, our optimism on the Indian economy and the Indian markets continue to be positive, and we would advise investors to continue to look at the Indian equity markets positively. And wish you a great financial year ahead. Happy investing and look forward to your support as always.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
What is a mutual fund and what are the benefits of investing in a mutual fund? Your financial requirements are likely to grow over time, and even though your income may grow at a steady pace, inflation will take its toll. Traditional forms of investment such as simple bank fixed deposits or investments in gold may not help you realize your dreams and goals. How do you derive the maximum benefit from surplus funds? How will your dream of buying a car, going on a holiday, or buying a house be realized? Mutual funds might be the answer. What is a mutual fund? A mutual fund is a collective investment.
There once was a poet who fell upon such hard times that he was no longer able to feed his family. So he decided to set out for the palace and appeal to the generosity of the king. Upon being summoned by the king, he started reciting his poems. The king, well pleased, asked him to name his reward. Pointing to the finely wrought chessboard, the poet said, "Your Highness, if you place just one grain in the first square and double it for every square, I will information and the scheme information document carefully."
All scheme-related documents carefully.
The financial advisory business is rapidly evolving from offering sales-based advice to advice-based sales of financial advice that ensures customers can avail of better performing financial products, portfolio monitoring, CRM, commission management, training, financial planning, and trailer monitoring. It serves as an efficient, low-cost, plug-and-play model for advisors to scale up their business in a standardized manner. Ifan also offers professional back-office services for product research, marketing, and legal and compliance. Ifan provides efficient online access to its clients, enabling them to monitor all investments under one roof. Manufacturers can access Ifan's widespread professional associate network across the country. The greatest benefit that an associate of Ifan would hold is with Ifan's assistance, he would be in a position to grow his business both in quality and quantity. Ifan's research-based B2B platform offers various asset classes, covering mutual funds, debt, equity, real estate, home loan, a company that enables IFAs to gain greater efficiency and the ability to tap into economies of scale and at the same time help them deliver better service performance for their clients without increasing the cost. Ifan has taken the initiative to lead the change and facilitate a paradigm shift from the current sales-based advice to a more effective, advice-based sales model in the financial services sector. Ifan.
0.25%. Why was this required? Couple of reasons. A, the overnight rate, which is the rate at which the interbank transactions happen, had gone way below the repo rate and was trading at around the reverse repo rate. This could have meant an implied easing of rates, which is something which we believe RBI could have been wary of. Number two, there is an excess liquidity in the system right now, which we believe RBI wants to gradually drain out. Is it likely to completely choke the system in terms of liquidity? The answer is probably not. But I think this band or the narrowing of the band would effectively mean slightly more orderly movement, especially at the short end of the yield curve. The markets obviously were expecting a status quo, so the impact was fairly muted as far as the short end of the yield curve goes. We saw an yields increase marginally in the band of about 5 to 10 basis points. The government securities market, or the G-Secs as we call it, had the biggest impact in terms of quantum of price fall or the yield rise. Now this was largely given the outlook table to us by the Monetary Policy Committee, which basically sees some upside risk to inflation. Of course, the FY17 or the March 2017 target for inflation has largely been met, but the FY17-18 inflation target has been broken into two halves. First half at about 4.5%, second half at about 5%. This effectively means that the RBI sees some upside risk to the inflation projections of being able to achieve the 4% mark. Now that obviously has not been good news for the markets, and even more important is, given the uncertainty on the global economic variables, as also coupled with the monsoon effects, the inflation impact, and the transient liquidity, the RBI believes that the rates will remain